Margaret Hale was 71 years old when she poured 2 cups of coffee out of habit, then remembered only one person was drinking them now. She lived in a small brick house in Dayton, Ohio, the same house she and her husband Walter bought in 1987 for $61,000. They'd paid it off in 2009. For 34 years, Walter worked as a machinist. Margaret taught 3rd grade for 28 years. Together, their retirement looked simple, a pension of $2,400 a month, Social Security checks totaling $3,100 a month between them, a modest IRA worth $340,000, built slowly, one paycheck at a time. Walter passed away on a Tuesday in March after a short illness. Margaret buried her husband on a rainy Thursday, surrounded by their 2 daughters and 5 grandchildren. 11 months later, she sat at her kitchen table opening a letter from her accountant. She expected condolences. Instead, she found a number. Her tax bill had nearly doubled. Nothing about her income had changed that much. She still had the pension. She still had the IRA. She'd lost only one of the 2 Social Security checks. But somehow, the IRS now wanted almost twice what she and Walter used to pay together. Margaret hadn't made a mistake. She hadn't done anything wrong. She had simply become a widow. Today, we're talking about one of the most misunderstood tax traps in American retirement, one that quietly affects millions of surviving spouses every single year. Almost nobody knows about it until it happens to them. Financial advisors sometimes call it the widow's penalty or the survivor's tax trap. It isn't a scam. It isn't a loophole. It's built directly into how the U.S. tax code treats single filers versus married couples. By the end of this video, you'll understand exactly how this rule works, why it catches so many families off guard, and what steps retirees and their spouses can take now, while both partners are alive, to reduce the damage before it happens. If you find this kind of retirement education valuable, take a second to like this video, subscribe to the channel, and drop a comment letting us know what state you're watching from. It genuinely helps more retirees find these videos. Now let's get into what actually happened to Margaret. Most people assume that losing a spouse means losing half your income, and therefore paying less in taxes. That seems logical. Less money coming in should mean a smaller tax bill. That's how it works for almost everything else in life. Millions of retirees believe this because, for decades, that's roughly how it felt while both spouses were alive. 2 Social Security checks, 1 household, 1 tax return. The math seemed to move in one direction, up together, down together. But here's what surprises most families. Income and tax brackets don't move together in a predictable straight line. They move together only as long as you're filing as a married couple. The moment a spouse passes away, the surviving partner typically shifts from married filing jointly to single filing status, usually starting the tax year after the death. And that single word, filing status, is where everything changes. It sounds like a small technical detail. It is not. The IRS doesn't just cut your standard deduction. It restructures the entire framework of which tax rate applies to which dollar you earn. Married couples get roughly twice the room in each tax bracket compared to single filers. So when a surviving spouse keeps most of the same income, the pension, the required withdrawals from the IRA, sometimes even the same 1 or 2 Social Security checks, that income no longer fits comfortably into the wider married brackets. It gets squeezed into single brackets instead, which are roughly half as wide. That's not the biggest problem either, because on top of the bracket shift, Social Security taxation rules and Medicare premium surcharges can shift too, sometimes triggered by the very same income that used to sit safely below the line. Here's where everything changes for families like Margaret's. Let's break this down in plain English, using real IRS structures, not guesses. For the 2025 tax year, married couples filing jointly pay a 10% federal rate on the first $23,850 of taxable income, then 12% up to $96,950, then 22% up to $206,700, and higher brackets above that. Single filers pay 10% only up to $11,925, then 12% up to $48,475, then 22% up to $103,350, roughly half the room, dollar for dollar, at every level. These exact thresholds adjust for inflation each year, so always check the current IRS tables for the year in question. Now apply that to Margaret. While Walter was alive, their combined taxable income after deductions comfortably filled the wide married brackets. A large portion of their income sat in the 12% bracket, with only a slice reaching 22%. After Walter died, Margaret's income dropped, but not by half. She lost 1 Social Security check, roughly $1,550 a month. She kept the pension. She kept the required minimum distributions from the IRA, which don't pause for grief and don't shrink just because a spouse passed away. Required Minimum distributions, or RMDs, are calculated based on the account balance and the account owner's own life expectancy, and they continue regardless of marital status. So Margaret went from a household income spread across married brackets to the same near-identical income squeezed into single brackets. Money that used to be taxed at 12% was now landing in the 22% bracket. Some of it crossed into 24%. That's the core mechanism. But there's a second layer most people never see coming. Up to 85% of Social Security benefits can become taxable, depending on what the IRS calls provisional income, a combination of your adjusted gross income, tax-exempt interest, and half of your Social Security benefit. The income thresholds that trigger this taxation are lower for single filers than for married couples filing jointly, so a surviving spouse can suddenly find a larger share of their remaining Social Security check taxed on top of already sitting in a higher bracket. And there's a third layer, one that doesn't show up on the tax return at all, but hits the bank account just as hard. Medicare Part B and Part D premiums are adjusted based on income through something called IRMAA, the Income-Related Monthly Adjustment Amount. The income thresholds that trigger these surcharges are also lower for single filers than for joint filers. A widow or widower with unchanged income can be pushed into a higher IRMAA bracket simply because of the filing status change, adding hundreds of dollars a month in Medicare premiums. 3 separate systems: tax brackets, Social Security taxation, and Medicare premiums. All 3 use the same trigger, filing status. All 3 can tighten at once in the same year for the same reason. Let's look at how this plays out differently depending on the household. Take Robert and Linda, a fictional but realistic couple from Arizona. Robert was a retired firefighter with a pension of $3,800 a month. Linda had worked part-time most of her life and had a smaller Social Security benefit of her own. When Robert passed away, Linda lost her smaller income advantage but kept most of his larger pension through a survivor benefit. Her household income barely dropped at all, yet her filing status flipped to single. Her tax bill increased by nearly 60%, and her Medicare premiums jumped into a higher IRMAA tier the following year, because IRMAA calculations typically look back 2 years at your tax return. Now take Diane, a fictional retired nurse from Oregon, a widow herself for over a decade. Diane had already restructured her finances years earlier. She converted a portion of her traditional IRA to a Roth IRA gradually in her 60s, paying taxes on smaller amounts each year while she and her husband were still filing jointly and had more bracket room to absorb it. When her husband passed, her required withdrawals were smaller because less of her money sat in accounts that forced taxable distributions. Her tax increase was real, but far smaller than Robert and Linda's. Then there's James, a fictional widower from Florida who didn't touch his retirement accounts early enough. By the time his wife passed, his IRA had grown large through decades of compounding, and his RMDs were substantial. Combined with his pension, his single filer tax bill nearly doubled, almost exactly like Margaret's. His IRMAA surcharge added over $200 a month to his Medicare premiums, arriving as a surprise almost 2 years after his wife's death because of that income look-back period. 3 different states, 3 different outcomes. The common thread wasn't how much money each person had, it was how their income was structured and whether anyone had planned ahead for the shift in filing status. This isn't a rule you can escape entirely, but it is a rule you can prepare for while both spouses are still alive. Some couples explore doing partial Roth conversions during years when they're still filing jointly, deliberately paying tax at the wider married rates now, instead of leaving a surviving spouse to pay it later at single rates. This is a strategy, not a guarantee, and it depends heavily on your specific tax situation. Some couples review their life insurance coverage, recognizing that a policy can help offset a future tax increase the surviving spouse may face, rather than assuming Social Security and pension income alone will be enough. Some families sit down with a fee-only financial planner or a CPA who specializes in retirement income to run projections, comparing what taxes would look like for the surviving spouse under current law at today's income levels. It's also worth understanding your state's rules. Some states tax retirement income differently, and some states offer additional relief for seniors or surviving spouses that federal law does not. None of this is personalized legal or tax advice, and none of it should be treated as a substitute for sitting down with a qualified CPA, tax attorney, or fee-only financial financial advisor who can look at your specific numbers, your specific state, and your specific family situation. The rules discussed here reflect federal tax law as structured for recent tax years. Tax brackets, thresholds, and IRMAA levels adjust annually, so always verify current figures before making decisions. Margaret never got to plan for any of this. Walter's death came fast, and grief doesn't leave room for tax strategy. She sat at that kitchen table with the letter from her accountant for a long time. Then she did something a lot of widows never do. She picked up the phone and called a fee-only financial planner recommended by her daughter. Together, they couldn't undo what had already happened for that tax year, but they restructured her withdrawals going forward, spread out future IRA distributions more carefully, and adjusted her withholding so the next surprise letter never came. Margaret still drinks 2 cups of coffee some mornings. She just gives the second one to a grandchild now when they visit on weekends. Here's the lesson underneath all of it. The tax code doesn't pause for loss. It doesn't ask if you're ready. The families who fare best aren't the wealthiest ones. They're the ones who understood this rule existed before the letter arrived. If someone in your life is part of a retirement couple, a parent, a grandparent, a spouse, share this video with them. It might be the conversation that saves them thousands of dollars and a very unpleasant surprise a few years from now. If you found this helpful, subscribe. We break down one hidden retirement rule like this every single week.